Benjamin Graham is widely considered to be the greatest investment advisor ever lived in the 20th century. Having some of the richest and most influential people including Warren Buffett, Irving Kahn, and Sir John Templeton as his disciples. Benjamin Graham is widely known as the father of value investing. Did you know that Warren Buffett himself described Benjamin Graham as the second most influential person in his life after his own father? And according to Warren, The Intelligent Investor is the best book on investing ever written. Hi, and welcome on the Online Money Web, the channel all about how to invest to become financially free. So, if you want to become an intelligent investor, take a deep breath, sit back, relax as we present to you the summary and some of the most important takeaways from the book. One of the most interesting and fascinating aspects of the book is the way Benjamin Graham has presented the concept of the stock market. He has used the metaphor of Mr. Market for the stock market. Imagine that you have a 40% ownership stake in a business. Every day, a person, named Mr. Market, visits your home with an offer for you to sell him your ownership stake or to buy more stakes in the same business. But the problem is that on some days Mr. Market is overoptimistic, and he values the business very high. But on the other hand, on some other days, he seems very pessimistic and presents a really low price for the same business that you own. So let's say that the business you have invested in is worth $100,000. This would mean that your stake in the business is worth $40,000. Mr. Market would come to you and one day offers you a nice price of $65,000 for it, and the very next day he will come to you and only offer you a price of $20,000. This despite the fact that there is no significant change in the revenues, the assets, or other aspects of the business that you have invested in. The point is that Mr. Market, which represents the stock market, is not rational. It is mostly driven by the optimism or pessimism of the investors at that specific moment. This makes the market unpredictable and unreliable. Good thing is that the market does not force you to buy or sell, it simply offers you a price, and it is up to you to put your emotions aside, and to do a rational analysis of different stocks, and use the market fluctuations to your advantage. This brings us to the next lesson from the book, the fundamental analysis. If you want to benefit from the stock market in the long term and really make a fortune out of it, it is extremely important to make decisions based on facts instead of emotions. This means that it doesn't matter if you have a liking for a company or if a company is trending because of expected future earnings, your decision to invest should be solely dependent on the key indicators of the company. During your fundamental analysis, you should take a look at things like EPS, that is earnings per share, PE ratio, that is the price to earnings ratio, and the long-term growth of the companies. The depth of your fundamental analysis will greatly depend on the type of investor you are. By the way, if you liked it so far and want to be notified when we release new videos like this, make sure to smash that like and subscribe button. We also added a link for a free audiobook of The Intelligent Investor that you can find in the description of this video. Now let's get back where we were. According to Benjamin Graham, there are two types of investors. The first type is the passive investor or defensive investor, and the second type is the active or enterprising investor. Most people are either passive or active investors. Passive investors don't want to spend time researching and analyzing stocks. They can make long-term investment decisions that give steady returns with little analysis. Usually such investors are better off investing in a mix of bonds and stocks. On the other hand, the active or enterprising investors needs to spend a lot of time researching and analyzing the fundamentals of different stocks. They really need to dive deep while doing the fundamental analysis and research a lot of companies to be able to make intelligent investment decisions. Active investors should read the financial statements and be up to date with the happenings in different industries and companies. Being an active investor requires a lot of patience, discipline, eagerness to learn, and lots of time. But the rewards are also higher. Did you know that Benjamin Graham is typically referred to as a great American investor, yet he was actually born in London, England? He also laid out a pretty good guide for both passive and active investors to follow. Value investing is all about finding companies that are trading under their intrinsic value, meaning their real value. Benjamin Graham suggests that investors should look to buy stocks that are undervalued. This means that you should look at the assets of the company, their revenues and liabilities, and then figure out if the stock price is overvalued or undervalued. You will regularly find companies that are very stable, are doing very well for several years, and are giving consistent returns to the investors, yet their stock prices fluctuate consistently based on the news and the market sentiment. You should look for opportunities to buy the stocks of such companies when they are undervalued. One of the most important lessons from the book is making sure that you keep a margin of safety while investing. When you are investing in a stock, no matter how much time you have spent on fundamental analysis, there is one risk that will always be there. It is the risk of being wrong. But the good news is that you can reduce this risk by keeping a margin of safety in every investment you make. Remember that the price and the value of a stock are not the same. If the price of a stock is 2/3 of its value, there is a sufficient margin of safety for you to consider investing in the stock. Finding the value of the stock can be tricky, but thankfully the father of value investing has solved this problem for us as well, thanks to the following formula. Value equals normal earnings multiplied by 8.5 plus 2 expected annual growth rate, where the growth rate should be equal to the expected yearly growth rate of the earnings of the next 7 to 10 years of the company. You will find many other smart formulas, strategies, and insights in the book. Benjamin Graham has also shattered the commonly believed myth that more risk means more reward. He logically explains how risk and rewards are not always correlated. Benjamin Graham is a great fan of diversification. He suggests that both passive investors and active investors should diversify their portfolios so that their returns are not dependent on the performance of one company or one industry. In a nutshell, The Intelligent Investor is a must-read book for anyone looking to invest in the stock market, passive or active. This book has produced many millionaires and billionaires, and we at the Online Money Web try to do our best to come with great book summaries about investing, so you can learn and make your own smart investment decisions. If you want to be notified when we release our next book summary, make sure to hit that like and subscribe button. Now here are the 5 key takeaways from this incredible book. Number 1. Understand the fact that Mr. Market, that is the stock market, is often irrational. Number 2. Make your investment decisions based on fundamental analysis instead of emotions. Number 3. Choose if you want to be a passive investor or an active investor. The type of investor you want to be will determine the time that you will spend on your fundamental analysis, and also the rewards that you can reap. Number 4. Invest regularly but keep a diversified portfolio. Number 5. Buy underpriced stocks. Do not buy overpriced stocks, and keep a margin of safety to minimize your risks and losses. That's all for now, and remember, as Warren Buffett would say, the more you learn, the more you earn. Thanks for watching. If you liked it and want more, make sure to click on my next video.